Well, hello, folks. It's top of the hour. We're going to go ahead and get started. I want to thank those that have joined us this afternoon for today's webinar. My name is Jerry Sicalisi. I oversee the advisor channel consultant team here at Sentinel. Today, we're going to talk about managed accounts in retirement plans. And I want to thank Wes Schevers of LeafHouse Financial, who's joining us today. Wes, would you mind sharing a quick introduction and talk a little bit about how LeafHouse is built a business supporting retirement plan advisors?
Yeah, most definitely. So first and foremost, Jerry, thank you very much for the opportunity to come be a part of this today. And thank you to all of our guests today for taking the time out of your day to hear a little bit more about managed accounts and how they're impacting the case space. Again, my name is Wes Schevers, and I represent LeafHouse as the VP of Sales and Fiduciary Solutions. If you've never interacted or worked with LeafHouse in the past, LeafHouse is a technology company that serves the retirement industry. We specialize in acting as a 338 discretionary investment manager. We currently manage the investment lineups for roughly 6,000 plans with assets under management right around 17 billion, and we're growing by about $1 billion a quarter. What makes us really unique in that 338 space is our advisor-centric model. We partner with advisors in the construction of plan investment lineups where we take control or we take feedback on the funds, any preferred fund families that you like to use or any biases you may have, such as a more passively biased lineup versus maybe a more actively biased lineup. The important piece behind this is it keeps you as the advisor in control of the plan. And we view this as we are a supporting arm of your firm. So we adapt to your needs, your value propositions as an advisor, instead of expecting you to adapt to ours.
Great. Thanks, Wes. As you can see, we've got a pretty stacked agenda. We're trying to keep this to 20 or 30 minutes. I'd encourage you to use the Q&A. We'll try to get to questions at the end. I know that we will likely not be able to get to all of them, and what we'll do is we'll follow up with a document and share that with the attendees. This is also being recorded. We'll distribute that as well. So with all that said, let's get started. Managed accounts they're not something new, right? We started to see them in defined contribution plans in 2004, and we've seen growth. We've seen exponential growth. In fact, today, 60% of retirement plans have a managed account option, and that's largely because the large market has adopted those types of investment options to participants, and they've almost become the norm. And if it's anything that I've learned in the 20 years in this business, is the large market is often a tone setter for what will happen in the small to mid-sized market, say 5 years down the road. And I think we're basically at that time now where we're seeing a lot of talk, certainly a lot of talk. I mean, Wes, you and I have seen each other at 4 or 5 national conferences this year. Mm-hmm. And I think the top talking point is managed accounts. And we've seen smaller record keepers sort of adopt the managed account philosophy, and they're adding them to their platforms. And I think if we were having this conversation 5 years from now, we're going to start to see the small to mid-sized market have heavy adoption into managed accounts. Wes, why don't you walk us through what a managed account is?
Yeah, most definitely. So on a very simplistic definition of a managed account, it is an individual investment account that is owned by the participant, but is ultimately managed by a professional investment manager. In this case, it would be LeafHouse. What makes them a little bit different is instead of kind of a one-size-fits-all retirement approach or investment approach like a target date or an allocation fund, this is a much more holistic approach to retirement planning. So it's going to consider multiple data points about an individual participant, and then even though they're all a little bit different, they're all ultimately going to create some level of a unique portfolio built around those data points about the participant to get them ready for retirement.
Great. So let's just talk about what's driving adoption. I think there's a pretty strong argument, personalization, right? We've heard that term over and over again, but I think from an investment perspective, personalization can better align the asset allocation strategy to take more of an investment risk for someone who may not be close to meeting their retirement savings strategy goal, and certainly can take less risk for someone who is aligned to meet that goal. And we've seen all these auto features. More participants want them. It sort of takes the decision making off their lap. And that just ties to bullet point number 2, everything from automatic enrollment, auto escalation, being able to do that through the record keeper's platform, even when an automatic contribution arrangement isn't in the plan. I think naturally the next step is, let's help our people with their asset allocation. As far as technology advances, Wes, do you want to expand on some of the things that have changed there? I know our partnership with iJoin has been a game changer, how we interact with plan participants. Perhaps you could expand on that and the fees.
Yeah, it's a great talking point. And I'd say since 2006, with the adoption of the Pension Protection Act, where managed accounts were identified as well as target dates and allocation funds as one of the 3 potential QDIAs inside of a retirement plan, two of the most common reasons managed accounts haven't been adopted, or there's been some level of reluctance to have widespread adoption of managed accounts, is that the limitations in technology and fees, right? And so how we refer to the limitation of technology is in the early stages of managed accounts, we refer to it as proactive participation. And so what I mean by that, or what we mean by that, is the sense of the early steps or the early days of managed accounts require the participant to be involved in almost to a certain degree, a manual process inside managed accounts. It would require them to go in and potentially do like a risk tolerance questionnaire to determine their risk position, to fill in their data points that were being considered inside that managed account. Well, with the advances in technology, it's kind of affected 2 things. It's created a ton of automation, which then allows scale. And then once you have that, it actually drives price down. So as technology has advanced and automation has certainly impacted the managed account space, it's now reduced fees, not across the board, but certainly the managed account that we have brought to market in collaboration with Sentinel is now roughly 6 to 10 times less what we've all experienced over the last 20 years with managed accounts.
Great. And I think when we look at personalization, it's not a question if participants want it. This is a recent survey. And if you look at all the surveys that are out there, this one's from Franklin Templeton, 87% of employees would be comfortable sharing information if their employers in exchange provided more personalized benefits. The personalization aspect, it impacts our everyday life with everything we do, and it's no different in the retirement plan. And when you look at the millennials and the Gen Z, the younger generation, it's not even a question if they want it, they expect it. So I think the more you can personalize, the more likely those participants will be better off in meeting their long-term sales goals. Managed accounts is one of those things. When I first got introduced to managed accounts, I was hesitant, right? We've got another thing in the retirement industry, but as I learned more about it, and what you need to really focus on is on the outcome. What is the managed account doing? Take the cost, put that to the side. That has to be aligned to the industry, and obviously it needs to make sense because a managed account is not for everyone. But there are people there that want the help. They can't afford an advisor, and they're looking for something in plan that'll help them with things like planning and saving for retirement, and really taking the work with the investment out of the equation. And they want it done for them, and they want the reminders. They want the help so that they're going to stay on track to meet their long-term goals. And when you look at a managed account, we've got over a decade of history, and you see the things like increased participation rates. You see the utilization of the match to the maximum, and it's no surprise. A lot of that is attributable to the touch points that happen with a managed account. Wes, do you want to walk us through QDIA or opt-in and some of the other alternatives to a managed account?
Yeah, most definitely. So I like to start this way. So when COVID affected all of our lives in different ways, and when COVID first hit, and the world shut down, as I had mentioned previously, LeafHouse is we're a fintech firm. So we, in those early days of COVID and being shut down, we utilized that as an opportunity to innovate and ultimately impact the market in a space that we saw a need, but also something that we really believed in, which is personalization. And we're going to elaborate that more here in a little bit. But during that time, we built a technology called Reallocate IT. And Reallocate IT is the portfolio management technology. Better way of saying it, potentially, it's the engine behind the managed account. And it bolts directly onto Sentinel's record-keeping chassis. So there's a single sign-on experience for that participant, which was very key for us, that it wasn't two different sites they were managing or two different sign-ons. It was a single experience for that participant. And with that being said, the positioning of that managed account, both on aspects we've already covered through technology and fees and so forth, it allows managed accounts to now be positioned in two different ways. And I would say this, how we're engaged and the flexibility of engagement when you're partnering with Sentinel and LeafHouse, we're going to cover that again here in a little bit, really comes down to where I recommend how that managed account is utilized. But it can serve as the QDIA on a retirement plan or an opt-in feature, either one. And certainly with the belief behind personalization and the price point now that we're bringing and delivering managed accounts to the market, we think it should serve as the QDIA, because ultimately it's going to drive a retirement plan that is constructed and built around each participant's unique lifestyle and retirement needs. So it's just again, not to belabor the point by any means, it's just a much more holistic approach to that participant, but it can serve in either capacity.
Yeah, and when you look at what's out there today, whether it's a risk-based model or a target date fund, I think it's now understood that one size doesn't fit all, right? 100%. And it's somewhat of a flaw of the risk-based model or the target date. But just because the target date of the risk-based model may not be right for all people, it doesn't necessarily mean it's right for some people. And that argument would hold true for the managed account as well. So let's focus on some of the factors here with the managed account and why it's so different and why we can title that personalization. I think just to understand, and even when there's obviously when there's an opt-in and a participant is engaging into the managed account, you're going to get more information, right? Because that participant is engaged. They're providing things like outside assets, maybe their spouse's information. You get more holistic with that view of that managed account. But just to understand how much data is there through the record keeper, right? We know risk and date of birth, whether you go in risk-based model or target date, but those other two don't have these other data points like salary and account balances and retirement needs and taxes and contributions, whether it's the employee's contribution rate or the employer contributions that are coming in and their retirement age. And as you can see, we can now sort of get this personalized experience for someone that wants it. And I think the argument with the QDIA, I think we've probably got some time where that becomes mainstream, but I think there's been a lot of scrutiny with target date funds this year, right? We've had a market turn down and the bond market hasn't fared out all that well, and that's having a negative impact on target dates. And one could argue a managed account may have been a better solution. So with that said, Wes, why don't you walk us through some of the customization that goes into the managed account?
100%. So the next two slides that I'm going to cover, candidly, I could spend probably 45 minutes by myself on these two pieces. So I'm just going to try to hit the high points, and then certainly we can do follow-ups on another day. But again, we believe in personalization. We believe personalization is certainly the future of the retirement side, which is, again, why we built Reallocate IT, why we have partnered with firms like Sentinel, because we believe and share core values in this area. So when it comes to the managed account, we feel we've built the first true managed account. And AMAs, for that advisor managed account, AMA is a very popular term right now in the industry. And again, Jerry couldn't have said it better. Probably the last half dozen conferences that I've either attended or spoke at, managed accounts has been a focal attention or a focal topic point throughout all of them. And AMA is certainly a word that comes up a lot, but we have built, just like our 338 side, where we have this very advisor-centric model. It was important to us when we built Reallocate IT that we also built an advisor-centric managed account. So the Sentinel LeafHouse managed account, or the MAP, it's designed to work with the plan's existing lineup as well as the advisor. So the goal is to bring this level of personalization to the participant, but not alter so much where you're changing everything, you're changing all the investments, and it's in any way viewed as a competitor to that advisor. It is a supporting arm to you as the advisor. So with that being said, kind of two ways to look at this. The managed account is built to be fully automated. I talked earlier about proactive participation on the early days of managed accounts. This managed account actually is built to never require any human interaction. So the moment it's established, it never needs the participant to ever go back in and do anything. It will actually auto update by itself every quarter based on the participant's date of birth. And certainly we want them to be active in it, but it doesn't require them. So it's literally going to evolve and adapt. So as they get older and lifestyle changes occur, they move from one state to another, one state that has state tax and they're moving to a state that doesn't. They get an increase in their salary. They grow a year older. That managed account is automatically going to capture those data points as they change. And if there's a variant difference enough, it's going to do a reallocation by itself. The technology is really, really incredible. And then using that existing lineup, it actually creates a unique portfolio for every participant that utilizes the managed account or adopts it. So every one of those participants are going to have literally, again, a unique plan to get them ready for retirement based on their own unique retirement and lifestyle needs. With that being said, we have, again, flexibility in our engagement, which we're going to cover here again a little bit. But when it comes to the investment lineup, on our side as the fiduciary, we only require that the plan lineup is 404C compliant. So it needs to have a bond position, an equity position, and a fixed position. Once we have that, we're happy and we can actually do the allocation based off that. And then again, on a fee aspect, we're all in at 11 bps, which is quite incredible. So once you add in the expense ratio, I mean, you're every bit is price competitive to a target date. So as we move on here, so the personalization with the advisor and control, again, a key aspect of the way we build this. And I think it's very important to point out this piece, which is the fiduciary positions of a managed account. So there's two levels. It's important to identify those two. So with any retirement plan, you have that plan level 338 fiduciary responsibility. And if it's not outsourced to a third party like LeafHouse, a record keeper potentially could sit as a 338 if that's something they offer. Advisors obviously every day sit as a 338. And if none of that is getting outsourced to a third party, then ultimately that plan sponsor is the fiduciary that is responsible for the overall monitoring and replacement of that the investment funds inside the retirement plan. In addition to the plan level 338, there's also the participant level 338 to the individual allocations for those managed accounts. Now, in LeafHouse's position, we can be one, we can be the odd, let me back up. I'm going to say that in a confusing way. So I want to make sure I clarify right off the start. We typically are always the participant level 338. There's an option where we're not, but typically we're always the participant level 338 because it's our technology in the background. And then who's sitting in that plan level 338 it's super flexible in how we can partner with one another. And it doesn't matter to us on either side. If that's something that's really important to you and that's part of your value position as a firm or as an individual advisor, then certainly continue to serve as the plan level 338, and then we can partner at the participant level. With that being said, so I just one quick thing, if you can just skip back, just in terms of the automated aspect. I covered all of those pieces, and again, it's really important to point out just the sense of the quarterly rebalancing based on the participant's date of birth. Again, no human interaction, automatic allocation and rebalancing when variant changes are enough. And then the participant, we're going to show you here in a little bit, actually gets a report sent to them anytime an allocation change occurs. Thanks, Jerry.
Yep. So when you look at the flexibility of this arrangement, the advisor has the opportunity to serve as the 338 to the plan, the 321 to the plan, with LeafHouse serving as the 338 to the participant. And if there's an advisor perhaps serving as a 321 and they want to outsource the 338 on the lineup, LeafHouse can take on that responsibility and own the engagement with the participant as well. So a lot of different ways to work with you, which was one area that was really attractive when we rolled this out in Landon with LeafHouse to start with this. So iJoin has been a partner of Sentinel. They're a technology firm. We've been working with them for about 3 years now. Those advisors that are on the webinar today are aware of this as really an enrollment and an ongoing engagement tool. It sort of takes the guessing away around how much I need in retirement. How do I know if I'm saving enough? And how do I close that gap to reach my goal? Well, naturally, when iJoin built the plumbing to support a managed account, we immediately thought, well, this is great. We could just tack this on to what we're already using. And through the relationship with iJoin, got introduced to the folks at LeafHouse, and they're just so innovative. Some of the things they're doing in this space is leaps and bounds beyond what we've seen with others. So with that said, this is just a sample of what a participant sees when they either re-engage into that strategy or they're enrolling in the first time, right? They're seeing the Social Security calc, they're seeing their benefit from this plan and any shortfall. Participants have the ability to toggle in and out with contribution rates that has an impact directly to their percentage to goal. But the account is also calculating the estimated return and factoring that in as part of that goal planning. What's going to be different when the managed account is added is today, without the managed account, they can either default into a target date fund, which is really easy for the participant, or they can choose a risk-based model portfolio if the plan has one, or they could do it themselves. This new option would be manage it for me, and that would allow the participant to engage into like a robo type of advice, fundamentally, where they can engage into LeafHouses. They're 338 to them, and the fee for doing that is 11 bips plus the cost of funds. Here, Wes, maybe you can walk us through this PRP.
Correct. Yes, definitely. So I mentioned this as a segue just a second ago in terms of anytime there's a reallocation that an automated report is sent out to the participants. So upon establishment, and I'd say this in the sense of if the managed account is set as a default investment, and after the 30-day opt-in opt-out period, the participant either goes into iJoin and establishes the managed account and accepts it as its default investment for their retirement strategy, or they never do anything and ultimately they're just enrolled into it. Immediately, they will receive this report via email. And it basically just outlines their personal retirement picture, gives them an idea of where they are in terms of percentage to goal, what their Social Security, what their Social Security, what their assumed Social Security take home is going to be at retirement, what their plan is, and then also if they have any potential shortfalls. On the right-hand side, you'll actually have the participants will receive a full list of the funds that are being utilized in the investment lineup with their unique allocation provided to them. Now, each quarter based on the participant's date of birth, again, we're always going to be monitoring, but each quarter based on that participant's date of birth, the managed account technology will actually review their data points. And again, if any variant changes are there that are enough to justify reallocation, then automatically that allocation is done. And this report will actually be emailed to them directly. This also works if they go into the system and they add anything. So let's say they're established and 6 months in or 5 months in, they go in and add spousal information, or they add and link some outside assets to the managed account. Well, we're going to use that data. And because now they're adding that, it might kick off a great enough variant change to create a new allocation. And as soon as they accept, boom, a new report sent to them automatically. It's something that you as the advisor don't have to do, but it gives them information on an automated standpoint anytime this occurs. Worst case scenario, if no changes occur throughout the year, this will be sent to them annually, no matter what. Great.
And our last slide here.
Yep. Yeah. So this is so if we are hired or engaged as the plan level 338, this just gives you an idea of what our reporting system looks like. So we have developed our own investment methodology that we call the LeafHouse GPA. It is how we monitor and score funds, very much similar to grade school, right? A is good, F is no good. Anything that's north of 2.4 is past. Anything that's south of it is on our watch list. But all this does is it breaks out fund by fund inside the investment lineup, gives the scoring per each category that we consider. And then on the very end, we'll give you an idea of what action, whether that's to keep it or to watch it or to replace it. But just gives you an idea of what our reporting looks like.
Great. We've got about 3 minutes. I'm going to shoot out some questions that have come in. One, Wes, maybe this is for you. What are some of the benefits you're seeing as a result of participants engage in managed accounts?
So our managed account offers participants a true personalization based on their unique lifestyle and retirement needs. While it captures data points automatically, we hope that participant will be able to provide more information into that managed account about them, because the more it feeds it, ultimately, the more personalized it becomes. Their specific needs, this, I'll rephrase what I'm going to say. This allows, a young conservative person or an older aggressive person to have a tailored portfolio, unlike, a target date fund, which dictates the portfolio only on the age base or the retirement of that individual participant. So with that being said, the participant will also have, more consistent returns. And then lastly, the participants, it'll eliminate the opportunity for participants, I can't get this out. It eliminates the opportunity for participants to have that bad behavior of selling in down markets and buying in up markets.
So we've got another question. I can run with this. It's, why would I add a managed account if I already offer risk-based models? I think it all goes back to that one size doesn't fit all, and just the value of offering choice to a plan sponsor. The managed account may not be for everybody, but there are people there that are going to want that personalized experience. There are people that are not going to want to be involved in their asset allocation, and through technology, you may be able to bridge the gap to get them closer to goal.